Something is changing in the gold and silver market right now that most retail investors are not seeing. Not in the price looks fine. Gold is near $4,700, silver is near $80, oil is above $100. The war is still happening, the Strait of Hormuz is still contested, the crisis is still real. What is changing is the positioning. Smart money does not wait for the crisis to end before repositioning. It repositions on the probability distribution, on the shift from active war with no diplomatic path to ceasefire with a framework for negotiation. That shift has already happened. Operation Epic Fury has been declared concluded. The United States' full focus is now on a diplomatic solution. The one-page 14-point memorandum framework is being actively negotiated between Trump's envoys and Iranian officials. The active military phase is over. The negotiation phase has begun, and negotiation phases have defined endpoints. Smart money is not waiting to find out when that endpoint arrives. It is already adjusting, quietly, without announcements, in the positioning data that retail investors are not watching, because they are still focused on the war headlines that smart money has already moved past. What retail is doing right now is what retail always does at this stage of a geopolitical cycle. It is buying the crisis premium at month 2 or 3, after the fear has been present long enough to feel permanent, after the elevated prices have normalized enough to feel like the new baseline, just as the mechanism that created those prices is beginning its reversal. This is Capital Briefing. If you are here for the first time, subscribe now before we go further. Activate notifications. What we build on this channel is the translation of what institutional capital is doing before the public narrative catches up. The gap between when smart money moves and when retail figures out why is exactly where the most consequential wealth transfers occur in every geopolitical cycle. Subscribe now, then let me show you the trap. Let me start with what the trap actually is, because understanding its mechanics is what separates the people who recognize it from the people who walk into it. The trap is not gold itself. Gold is not a trap. The structural case for gold, fiscal expansion, central bank accumulation, debt dynamics that make monetary debasement the path of least fiscal resistance, is intact. It was intact before the Iran war began. It will be intact after the Iran war ends. The trap is the crisis premium layered on top of the structural case. When the Iran conflict began in late February, gold was trading near $5,300. In the initial panic phase, it spiked above $5,400 before the mechanical suppression took hold. The oil-driven inflation expectations that froze the Fed, elevated yields, and strengthened the dollar all simultaneously pressed gold lower as oil rose. Gold fell from $5,419 to below $4,700. That fall represents the mechanical suppression of the structural bid by the crisis-driven headwinds. It is counterintuitive. Gold is supposed to go up during wars, but it is the documented pattern from every major oil shock since 1973. But here is what happened next. As the conflict stabilized into a ceasefire without a peace deal pattern, gold stabilized in the $4,700 to $4,800 range. The structural buyers, central banks, long-term institutional allocators, physical gold markets in Asia began accumulating at these suppressed levels. And retail, watching gold stabilize and the crisis persist, began to believe that $4,700 to $4,800 was the structural floor. That the conflict premium had already been priced out. That gold at these levels represented the structural case, not the structural case, plus an unstable crisis overlay. That belief is the trap. Because what retail is buying at $4,700 to $4,800 still contains a crisis premium component, the assumption that the Hormuz closure and its effects on inflation expectations, Fed policy, and dollar strength will persist. When the diplomatic resolution arrives and that assumption changes, the crisis premium component clears from the price. How much is the crisis premium worth in gold at current levels? The structural forces alone, without the Iran crisis, without Hormuz, without elevated oil, would place gold somewhere between $4,200 and $4,400 based on the trajectory of central bank buying debt dynamics and monetary debasement that existed before February 2026. The remaining $300 to $500 above that range is the crisis premium that has not yet fully cleared. That $300 to $500 is what retail is buying today, and it is what smart money is selling. Subscribe to Capital Briefing if the distinction I just drew between the structural case and the crisis premium overlay represents the level of precision you have been looking for. Activate the notification bell. The next video maps the specific institutional positioning indicators that show when smart money is exiting crisis premium positions, what the COT data structure looked like before the 2022 Ukraine premium unwound, what futures positioning showed before the 2020 pandemic premium unwound, and what current data is showing right now. Subscribe now. Then let me explain why the timing of this particular trap is more dangerous than most. The specific danger of the current moment is not just that the crisis premium exists, it is that the crisis premium is unwinding at exactly the moment when retail comfort with the position is at its highest. Month one of a crisis is characterized by retail paralysis. The shock is new. The uncertainty is high. Retail either panic bought the initial spike or watched from the sidelines. Month two is characterized by retail uncertainty. The crisis has settled into a pattern, but it still feels dangerous. Retail is watching but not fully committed. Month three, which is where we are now, is where retail walks into the trap. The crisis has been running long enough to feel like a permanent condition. The elevated prices have been present long enough to feel like the new baseline. Financial media coverage has normalized the crisis. The fear that was acute in month one has become ambient, always present but no longer paralyzing. This is the moment retail feels most comfortable entering, and it is the moment the crisis premium is most vulnerable to rapid reversal. Because the same normalization that makes retail comfortable entering also makes the diplomatic resolution less dramatic when it arrives. A peace deal in month three does not feel like the end of a crisis. It feels like one more news event in a crisis that has been generating news events continuously. Retail does not immediately recognize the repricing signal. Smart money does. Because smart money is not reading the diplomatic headlines. It is watching the oil price trajectory, the DXY, and the 10-year Treasury yield, the three mechanical indicators that determine when the crisis premium reversal is actually in motion. On May the 12th, annual U.S. inflation came in at 3.8% in April, above the 3.7% expectation, while Brent crude surged above $108 per barrel, and the combination of sticky inflation, elevated oil, and uncertainty surrounding interest rates created a difficult environment for equities as Treasury yields climbed and traders reduced expectations for near-term Federal Reserve rate cuts. This is the current environment. Inflation above expectations. Oil above $100. Rate cut expectations being scaled back. Dollar elevated, yields elevated. These are the conditions that mechanically suppress gold, but they are also the conditions that will reverse most rapidly when oil falls, when the Hormuz supply shock resolves and the inflation expectations embedded in all of these variables begin to moderate simultaneously. Smart money is not waiting for the moderation to appear in the data. It is positioning ahead of the moderation that it believes is coming, because the diplomatic framework is in place, because the active military phase is over, because the probability distribution has shifted from continued escalation to negotiated resolution. Now let me describe exactly what the trap looks like when it closes. A peace deal headline arrives. Oil falls. The initial reaction in gold is ambiguous. The structural case suggests gold should benefit from lower yields and a weaker dollar that follow from lower oil, but the crisis premium unwind hits first and hits harder. Leverage paper gold and silver positions, the positions added on top of structural positions when the crisis began, face the prospect of rapid margin calls as the oil inflation expectations yield dollar chain reverses simultaneously. Managed money desks that added crisis exposure begin reducing it systematically. The selling is not driven by bearishness on gold. It is mechanical. It is the unwinding of positions that were open for a specific reason, the crisis premium. When that reason resolves, the price falls. Retail, watching the price fall after a peace deal, ask the question they were trained to ask: is the gold trade over? That question is the final stage of the trap, because the correct answer is no. The crisis premium portion of the trade is over. The structural trade is beginning a new phase. But retail cannot distinguish between the two, because retail bought the crisis premium price without understanding what portion of that price was premium. So retail sells into the bottom of the overshoot, exactly as institutional capital is absorbing at structural floor prices. The wealth transfer from retail to institutional capital in the gold and silver market happens at this specific moment in this specific way in every major geopolitical cycle. Not because institutions are smarter, because they understand the structure of what they own. Now let me address silver specifically, because silver's dynamics in the current cycle make the trap more dangerous for silver holders than for gold holders. Silver at $80 per ounce is carrying a larger crisis premium percentage than gold at $4,700. The reason is silver's dual demand structure, approximately 60% industrial, 40% monetary. During the crisis, both demand channels reinforced each other. The monetary channel from flight to safety, and the industrial channel from the expectation that oil-driven inflation would accelerate green energy infrastructure spending to reduce energy dependence. When the Hormuz crisis resolves, both channels reverse simultaneously. The monetary flight to safety demand exits, and the industrial demand signal moderates as oil falls, because falling oil reduces the urgency of accelerating alternative energy infrastructure in the short term. Silver's characteristic pattern in crisis premium reversals is to fall harder and faster than gold. The 1979-1980 reversal, gold fell 47% from peak to trough. Silver fell 72% from peak to trough. The ratio between them during the reversal was more extreme than the ratio during the buildup. Current silver at $80 per ounce is already down from $120 at the January peak, a 33% decline that represents the crisis mechanical suppression phase. But the crisis premium overlay that was added when peace signals emerged is still present. When the full resolution arrives and the crisis premium clears completely, silver's volatility profile means the overshoot below structural floor could be significant, more significant than what gold experiences. And silver's structural recovery from the floor of the overshoot is also more powerful, because the 5-year supply deficit, the inelastic industrial demand, and the China export restrictions all remain in place after the crisis resolves. The trap in silver is not to avoid silver. The trap is to buy silver at crisis premium prices, and then sell during the crisis premium reversal, because the price action looks like the structural case has broken. Smart money accumulates silver during the structural floor of the overshoot. Retail sells during the same window because they do not know the difference between the floor and the collapse. Now let me give you the specific signals that will tell you when the crisis premium reversal has completed, when the structural floor has been reached, and the institutional accumulation phase is actually underway. The first signal is the dollar index below 97, currently elevated above 99 due to the petrodollar demand surge. When DXY falls below 97, the primary mechanical headwind on gold and silver prices has materially diminished. This does not happen on a peace deal headline. It happens when oil has actually sustained the move lower, when the physical Hormuz supply has returned to the market and the emergency dollar demand that the supply shock created has genuinely declined. The second signal is the 10-year Treasury yield below 3.5%, currently at approximately 4.39%. When this falls toward 3.5%, the opportunity cost argument against holding gold has weakened to the point where institutional rotation back into gold is mechanically favorable. This happens when the Federal Reserve begins cutting rates, which happens when the debt arithmetic of $39 trillion at 4 to 5% creates fiscal pressure more severe than the inflation risk the elevated rates were designed to manage. Between those two signal points, Between the peace deal headline and the DXY yield confirmation is the window of maximum retail confusion and maximum institutional opportunity. Retail sees prices falling after peace and concludes the trade is over. Institutional capital sees the DXY and the yield and knows the trade is just beginning its structural phase. Let me close with the observation that I believe is most useful for anyone currently holding gold, silver, or energy assets. The safe haven trade is not over. The crisis premium portion of the safe haven trade is ending. Those are different statements with different implications. If you hold gold and silver at current prices and you do not know what portion of your position is crisis premium and what portion is structural exposure, you are holding a position you cannot accurately interpret when the crisis resolves. And when the crisis resolves and the price falls, as it will mechanically, as it has in every comparable cycle, you will make the most expensive decision based on the most incomplete information. The investors who will profit most from the next 18 months of gold and silver are not the investors who bought the crisis premium. They are the investors who understand the structure of the premium well enough to recognize when the structural floor arrives, and have the clarity to accumulate at that floor rather than sell into it. The price of that clarity is understanding the mechanism before the resolution happens, not after. Subscribe to Capital Briefing now if this video changed what you understand about the distinction between crisis premium and structural case in the current gold and silver positioning. Activate notifications. Leave one comment. Are you holding gold and silver right now because of the war or because of the structural case? Because your answer to that question determines whether the peace deal is a risk or an opportunity for your specific position. They want you buying now. They want you holding the crisis premium they are selling. The question is whether you know what you own